Welcome to the live stream, the internal debate. We all have an internal debate with ourselves about making decisions, in particular, financial decisions. Your psychology comes out to me the most clear way is through financial decisions. See how somebody is with money, how they live using money? That'll tell you a lot about that person. Doesn't mean good, doesn't mean bad, and not everybody's the same. But I know for me, I have my own internal debates about. I have. I know for me. Well, trying here. I know for me, I have my own little internal debates when making decisions of what stocks to buy for which clients, which bonds to buy for any particular client. They're not all the same. So just because I like a stock and it's appropriate for some clients doesn't mean all my clients are going to get it. In fact, rarely do I find an investment that I think is good for everyone. I just don't think it exists. And I'm not saying I'm not talking about a money market fund or some kind of fund that could pay a higher yield while you're waiting for an opportunity or you're taking some time to think about your next move. In that case, making more in your cash, it's not really an investment decision. It's really just an efficiency decision. So I have to do a better job really documenting my internal decision. Now, I have documented decision trees on all kinds of things financial, especially for my business, especially for my clients. But there still is an internal debate of should you buy now? Should you wait? One of the ways I handle this is using something called limit orders. I'll talk to you about that in a moment. I will go through the quick update with perspective because remember, this is be the boss of your money. You're not going to become the boss of your money by watching more TV shows or podcasts that tell you what happened in the market or market updates. This is about adding perspective. This is about adding the benefit of my experience over 30 years as a financial advisor. Good moves, bad moves, and everything in between. About how clients have overcome financial challenges that I've learned a lot from and how I've helped clients overcome financial challenges. I pour it all out here. That's why you should watch the show. If you don't mind, give us a thumbs up or some reaction, depending on which social media platform you're watching on. I'll be right back. I'm going to roll the introduction. If you have any questions about what we're talking about, please hit me up in the comments. Hearing from you is by far the best part of doing this. And now we're going to roll the intro. I'll be back in about 20 seconds. Thank you for joining me. My name is Mitch Goldberg. You can check me out at clientfirststrategy.com. I'm all over social media. You can find me on these cool places, okay? Instagram, YouTube, LinkedIn, Facebook, or X, as we used to call Twitter. Okay, I'm also on the new Threads, but I haven't used it for business yet. That's the Twitter version coming from Instagram and Facebook. Okay, so follow me there. Give me a thumbs up, and let's get into it. Internal debate. The stock market had its best week this year. Last week, major averages: Dow up 5, S&P up almost 6%, Nasdaq up well over 6%, about 6.5% in 1 week. I mean, if that was a year, it wouldn't be the worst thing, right? I mean, that would not be it would not be a terrible year. It would be a little bit below the long-term average, but if your long-term average is 8.5, 9%, and you scored a 5 or 5.5% upside in a year, it's not the worst thing. I mean, Nobody's going to complain about it. Now, if the market went up 40% and you went up 5%, yeah, I think we could have something to be a little PO'd about. But by and large, last week was like a year. And it just goes to show you how quickly things could change and why it is so hard to make this all or nothing decision. I'm going to buy stocks. I'm going to put them away for the long term. But then the stuff hits the fan and you're like, I don't know if I want to do this anymore. Maybe I better sell and get back in at a better time. I'm going to do air quotes, a better time. I'm saying air quotes for those of you who are listening and not watching. I just did air quotes. So is there a better time to invest? I don't know if it's worth even contemplating it. I think if you call for an asset allocation of stocks, bonds, and cash that could help you meet your goals, then you go for your allocation. Okay. I don't like to see investors get all twisted. Today, there were, in the media, like I'm not a media basher, I'm really not. But the people being quoted today are people who are mostly optimistic. Well, we have some good news. The Fed has turned around. We've got a better number for the employment figures last Friday, which shows a moderation in employment and wage gains. And that is exactly what the Fed wanted to see with regard to slowing down or halting their interest rate hiking cycle altogether. That's bullish for the market. Investors are excited about that. And statistically, when that happens, stocks have a pretty darn good track record of going up like 100% of the time in the last 40 years. But we really won't know until after the fact. And even now, you're going to hear, but we're not out of the woods yet. I can't say that. But, the consumer could be stretched. The Fed could still keep raising rates. Wars could break out of their geographic confinement and spread. We could have a blow up in another bank, like Silicon Valley Bank. All kinds of things that could happen. We're not out of the woods. People have to do that. Well, we had a good week, but we're not out of the woods yet because that person knows something, right? It's interesting. It's like you must be really smart. The bearish side is always sounding very smart. The bullish, because you're aware of risks. The bullish side doesn't always sound smart because being a bull, being an optimist, does require a good amount of blind faith, doesn't it? I mean, think about that. You're putting your money into the stock market that could go up or could go down. Your hard-earned money. That's crazy. What are you putting your money into? But we know that the optimists have continuously won. I have no reason to expect that to be discontinued. So this is why the optimists don't always sound as smart. Because you say, well, these things could happen and go right, but this could be bad. That could go wrong. We're not out of the woods yet. I can't stand that expression, but we're not out of the woods yet. No poop, Sherlock. We know that. We're never out of the woods. There's always something new to worry about. There's always a boogeyman hiding behind every corner, but there's always going to be something bad that happens in the economy, in the world, in the market. It's not going to end. And if you're waiting for the all clear signal, and it does seem like things keep getting more difficult in so many regards, but if you're waiting for an all clear signal to get invested, either you'll never invest or things will be so good and stocks will be so richly valued that it's probably not a good time to invest. I use the word probability, because we don't really know for sure. But I do know that we have time to let our investments ride. We have time to let corporate managements build their businesses, cut their costs, reinvent themselves, invent a new technology to make them more efficient, more productive. New technologies, new products. Things are always changing. And it's not just a matter of holding on to the same stock forever. There was a time you could hold on to IBM and GE forever. There was a time that Intel was considered a forever stock. And at that time, Apple was considered a bankruptcy. No one would want Apple. They made these weird little computers that nobody wanted, that you didn't need, that nobody could even understand why you would own one. And look at today, look at Apple, how great it is. Look at IBM, which has basically been dead money, but for the last 20 some odd years. So things are always changing. It's a reason why we diversify, why we, a diversification. It's a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Now, that's short termism. It could be long termism. But basically, when you're diversified, what you're doing is let's say you invest in 10 companies, you're giving yourself the ability to say to yourself, one or two of these companies could fail and go out of business permanently. One or two companies could go down and never really recover. One or two companies might just sit around here and never do anything. I'm talking as far as the stocks go. And one or two could go up a lot. In fact, one could go up so much that it makes me rich. Microsoft, Apple, Nvidia, Tesla. You know the companies. You know the names. The ability to hold on to these stocks through thick and thin, through every couple of years, to see them go down 50% and still hold on to them, that takes an internal debate. That takes strong internal fortitude to do that. That takes a lot of blind faith, right? Doesn't it? A lot of blind optimism to think that a stock like Nvidia could go down by half last year and go up over 200% this year and be this year's biggest winner in the stock market. This is what it takes to be an investor. And if you're worried about individual stocks, there's nothing wrong with going for a fund that tracks an index, like the S&P 500, for example. There are many indexes, and there are many more exchange-traded funds and mutual funds that track these indexes. There's no reason to not put together a portfolio, unless, of course, you have absolutely no money. But this shouldn't be a matter of belief anymore. Oh, the stock market, you could get burned, you could lose money. That's a bias, a misguided belief. This is part of the internal debate, right? This is what we're talking about. Always going to the stock market thinking, I'm going to lose money, I could lose money. It's a bias. We know realistically the bias of the stock market long term is up. New companies are created, old companies go away, new management teams come in, develop a technology that makes the world more fun or more efficient one way or another. Facebook, Google, and they become the next big winner. It's hard to know what they are in advance. When Google went public in 2003, we needed a new hero in the stock market. But Google was a silly name. And it was another search engine in a world of lots of search engine companies that the stocks had already gone down to zero, like Lycos and At Home and Excite. Those are the ones that come to mind. Because AOL, right? You could use search in Yahoo. Even Microsoft never could catch up to Google. They basically tried to do it with Bing, never really did anything. Now they're trying to do it with artificial intelligence, the AI chat, whatever it is. It evades me at this moment. It takes a lot of intestinal and internal fortitude to be a long-term investor. And yet, so much wealth has been created and so much money has been lost by paying attention to the short-term market news, the war, the things that take place. They pass, we go on. Let's take a look at the major averages. A couple of points we'll make, and then I got to get out of here because I got a hot date tonight. Okay. Dow up 34 points, NASDAQ up 40, S&P up 7. Very nice to have gains after last week. We didn't pull back. The gains continue. This is a good thing. It's healthy. Even if we pulled back a little bit, it would be healthy. But nonetheless, Stocks are up a little bit today. These gains these gains are modest gains, but certainly they sure feel very modest in light of the gains from last week. Gold down $14 the ounce. Oil, which was down to $80, it's still a little over 80, but down a lot. You see that price at the pump going down, right? 10-year yield up a little, 4.6. It was a 4.5. The VIX steady Eddie in the high 14s. Let's take a look at interest rates. From the 1 year down, you're still getting over 5%. The problem with that is in another year, those rates could be lower. They could be higher. But if they're lower, you face something called reinvestment risk. Let's say you buy the 1 year at 5.339% yield, and a year later it matures because it's a bond, it hits maturity, you get your principal back, plus you keep that interest of 5.339% you made on the bond. But next year, the 1 year could be trading at 4% or 3% yield. So where do you reinvest, right? So if you have $1 million earning over 5%, in this case, $53,000, great. Next year could be $35,000. That's a big haircut. And then you have the 10-year, which was recently 5%, now down to 4.6%. That's a pretty sizable difference. But the point to me is I didn't wait to see if rates are going higher. I've been talking about treasuries for the last more than a year now because yields have finally given us yields that we can count on that are pretty good, better than the 0% we became accustomed to getting. In fact, so many people are accustomed to getting 2% that they're still leaving trillions of dollars in bank deposits when they could be getting a lot more money in CDs, in treasuries, and other higher yielding cash equivalents that are stable. So the 10-year below 5%, even the 20-year and the 30-year below 5%. So rates sure did come down last week, and we'll have to see what happens, right? We'll have to just see what happens. Now, the chase is on. Stocks are up. Turnaround, they're up modestly for the year, but they turn around, and all of a sudden, the people who sold the last couple of weeks decide they have to buy everything back. And now that the market's galloping ahead with less than 2 months left to this year, and you're starting to really feel that pressure of the year-end performance, your 2023 performance, with stocks starting to go up and turn around, and you're too invested in cash, you're holding too much cash, you have to start buying stocks with both hands. And you're going to buy the stocks that are going up the most, which makes them go up even more, because you want to show those winners on the books, on the window dressing, come next January. The chase is on. But you balance that out with this comment from Marco Kolanovic, and I have the utmost respect. He's one of the best market callers there are. And again, when he makes a market call, it doesn't mean I'm buying or selling on it. It just feels good when he agrees with me. And, it would be nice if he agrees with me more. Okay? He says, we believe that equities will revert back to an unattractive risk reward as the Fed is set to remain higher for longer. Valuations are rich. Earnings expectations remain too optimistic. Pricing power is waning. Profit margins are at risk. And the slowdown in top line growth is set to continue. He thinks this whole bull market rally we had is really just a rally in a bear market, because during bear markets, your upside rallies are often the biggest, right? During bear markets. Same thing with bull markets. Sometimes your biggest down days are in a bull market. It's confusing, isn't it? Up is down, down is up. I know that the Fed has a lot to do with this. I know interest rates have everything to do with this. And as we start seeing softening numbers in employment like we did last week, we start to see wage gains moderate. We start saying the Fed is seeing the slowdown that it wanted to engineer so that it could stop raising rates, hold them steady, then maybe even start cutting rates. But a slowdown in the economy could look a lot like the beginning of a nasty recession. And we won't know until after the fact. Remember what I said? Internal process, blind faith. And this is when you're going to be tested. Should you hold on? Should you buy more? Should you just say, you know what? I'm in it for the long term. I'm investing every other week in my 401k plan. Or do you make sudden, bold moves? My thing is incremental wins the day. Make incremental moves now so you're not behind the eight ball trying to make a bold move when it's impossible to think straight under times of duress. Anyway, that's what we do here. I appreciate you watching today. I'm going to get going and I'll be back tomorrow. Thank you.